A few weeks ago, I made a video that explained why economic growth so far in 2021 post pandemic has actually been weak and why GDP numbers are insufficient at telling us the whole story of what's going on in our economy. And if you want to view that video, I have now rearranged my channel on YouTube. So if you go to Economic Analyst and you go to my channel, you can now view all the videos that I have made based off of subject. And so if you wanted to view my GDP growth video, my previous one, you can see it here under Economic Analysis and Projections. Now back to this video. I wanted to recap and cover that metric because I've sort of improved upon it. Okay, so to recap on this, here's your real GDP story. So according to the story that is told, our economy suffered a horrible, horrible recession in quarter two of 2021, really started in quarter one of 2020 and quarter two of 2020, not quarter two of 2021. And this was caused by shutdowns from our governments and from the world governments and global disruptions from the COVID-19 pandemic. This was the worst recession that we've had on record in terms of negative GDP growth. And then as the economy started to reopen, we've been bouncing back, and thanks to government measures to quell the virus, as well as stimulative measures to boost consumption in the economy by providing benefits to those in need, our economy is now back on the upswing here. So we're beginning to recapture what we lost here in this year of 2020, and with further injections of government spending and monetary stimulus to support the economy, this will continue to move up and push up as we recover from this pandemic. And here's the percentage change on a quarterly basis. Now take note that when they tell you the headlines of how much GDP grew, those are annualized basis, not quarterly basis. So you would have to take this and raise it to the fourth power in order to get the annualized growth, which would be about 6.2 to 6.3%. So you can see here the horrible, horrible drop in percentage quarterly GDP growth for quarter one 2020, quarter two 2020. You can see the huge bounce back that we had in 2020 for quarter three, and then we sort of settled down, and now we're growing here, okay? And if you were to take a look at the yearly growth rate in GDP, it would look like this. So now that because we dropped so staunchly in 2020, our year-over-year change in GDP growth has grown to a whopping 12%, which is just incredible. We have never seen this kind of change on a year-over-year basis in our economy. I don't think since we've ever started taking measurements. I think here we go back. We have to go all the way back to 1950 to see this. So looks like that the government stimulative measures have worked, right? That's what's really growing our economy. And with further stimulation, so with further stimulus and to send out more paychecks, government investment and government consumption can sort of cover for the private sector loss. That's the narrative that has been told. And of course, in my previous video, I told a different story to give you a more complete picture. And now I'm going to finish that painting with this video. So in the previous video, I pointed out that there's another metric that started to be developed that was developed about 15 years ago called the gross output. And the economy has two sides of a coin to it. You do have the consumption side, which is measured by GDP, and that's what we commonly used. But we also have the producer side of the economy, which there is no direct metric to use, but the gross output contains the producer side of the economy and the consumer side of the economy in its metrics. So it's GDP plus the producer side of the economy. And when I controlled for producer prices on the producer side of gross output and then consumer prices for the GDP numbers, I showed you in that video how the GDP numbers were actually weak. But that story was incomplete, and the reason why is because of two components that are found in GDP. The first one is called gross private domestic investment. And the second one is the government investment component portion of the government portion of GDP. Okay? So it is government purchases of intermediate goods for GDP. In the explanation for what government investment does, the government purchases goods and services in two fashions. One, it purchases intermediate goods, and two, it pays wages and salaries. So the wages and salaries portion of government spending is true. That does go to consumption. So does transfers, which are captured in the consumption component of GDP. But the purchase of intermediate goods, in my opinion, should not be captured with the consumer price index, which is what we use to control for prices on GDP. And the reason why is because that money that is spent doesn't go to consumer goods. It goes to producer goods, which are intermediate goods. The same is true with gross private domestic investment. That's the portion of the GDP that businesses invest into future production. So what I did is modify the gross output numbers. And I basically created several things. One is that I created a real producer output, which is the gross output minus the GDP, but adding back in the domestic investment from both the government and the private side, and then controlled that for the producer prices. And then I did the real consumer output, which is your GDP minus your gross private domestic investment minus your government investment, and controlled for consumer prices. And you get this chart right here in the aggregate economy. The orange line is your real consumer output. The blue line is your real producer output. You can see here that in 2008, how the producer side of the economy started to really falter and fail in the late quarters of 2007. So starting in 2007 and really late quarter of 2006, the economy sort of peaked here on the producer side. And in my opinion, the producer side is more important than the consumer side, because if you're not producing goods, then you can't consume any goods. So if the producer side of the economy fails, the consumer side of the economy will also fail. And notice here how the producer portion of the economy plummeted in 2008. And it really took all the way back until 2014 for that producer side of the economy to recover. And the reason why is because of that would explain all the weak growth that we saw in the GDP. But I think the reason why that it took so long for it to recover is because of the high producer prices that were not allowed to fall after 2009. So here's your producer price inflation here chart. You can see how it spiked with oil prices, then it plummeted in 2009. Then you had all the stimulative measures by the monetary policies and fiscal policies to try to generate growth in the economy, and that drove commodity prices back up, which then started to hamper growth in producer output. So in other words, government spending and monetary policy, expansionary monetary policy, aka money printing, doesn't really grow the economy. It actually hinders economic growth, especially the government spending portion. The monetary policy portion has a different, more insidious effect, but that's something I'll cover in a different video. Now, what I found interesting here, and I did point this out in the last video, but this chart kind of spells it out, is look what happened in quarter 2 of 2021. Quarter 2 of 2021 is pointing to that the real producer output is starting to plummet again. It dropped very sharply. And why? Because producer prices are increasing at very, very high rates. I'll touch on that in just a little bit. So now, when we take a look at the real gross output, which is a combination of your real producer output and your real consumer output, you get a chart that looks like this that spells the story of the economy much, much better, in my opinion. So here we can see the historic drop in gross output in 2008 and 2009 as the housing bubble collapsed. Then we can see the languishing recovery, the weak recovery, and then we see the sort of boom phase go on in 2014 and 2015 as fracking allowed us to tap into shale oil, and that dropped the price of oil, which dropped the price of commodities, allowing for more expansionary output on the producer side of the economy, which lifted our GDP and lifted our economic growth over time. Then you can see the COVID collapse and the rebound. But notice here that we never did recover back to those previous peaks according to the real gross output formulation that I've made. And now look at what's going on in Q2 of 2021. We are actually falling again. And so if we were to do a percentage change in gross output, it would look like this. And you can see here how it's looking like, yeah, we fell by almost 2%. We almost contracted by 2% in Q2 on a real term basis because of those high producer prices. And every time that the economy has contracted by more than 2% in a quarter, it's usually led to a collapse in economic growth, okay? Or at least languishing economic growth. In real terms, when I say that, I mean that in terms of GDP, but in real terms, I mean in terms of our real economy. So yes, our real economy, in my opinion, actually contracted in 2021 for Q2 instead of those growth numbers that we've been seeing. And the government stimulus is sort of squandering and crowding out that private investment component. If we're not careful and this continues, it may drag those GDP numbers negative, and I also covered that in the previous video. The year-over-year change in the gross output then is about 4.9%. That's countering that. This is including the fact that we dropped and bottomed out in Q2 of 2020 instead of this 12% that we're seeing on the yearly growth measured by the gross domestic product. So our economy is a lot weaker than what we're actually stating it to be. And if producer prices continue spiking the way that they have, we may actually go into a full-blown recession in late 21 and 2022. Now, that being said, I do want to point out, and I'm going to make a video over this, there's something interesting going on in commodity prices right now. If you've noticed and started looking at sort of the commodity price fields, those prices aren't going up. They've sort of peaked for now. And I'm going to make a video in the next few days that's going to talk about why I think they have peaked and where do I think they are going to head from here and what does that mean for the economy. So even though we contracted here in Q2 of 2021, it may be that we sort of rebound in Q3 of 2021 if producer prices cool down on their price hike increases. Now, I don't think that will actually filter out into slowing the consumer price inflation right away, but I do think that the cooling down I think it will definitely affect the gross output calculation, obviously, because I control for producer prices, and hopefully show that there's actually a rebound going on and that we were just seeing this inflationary spike. And I'll talk about that in a video in the next coming days. Guys, thank you for watching this video. If you like my content, make sure you click that like button, subscribe to my channel, hit that notification bell to get updated with more and more content that I put out. And once again, I thank you for all the views and support that I get. Let me know what you think. Don't hesitate to comment and just follow me on this channel, and I'll just keep pushing out these videos. Until then, I'll talk to you next time.